Hello and good morning friends, welcome to the CEC-UGC live lecture. Dear friends, as you know that in our previous sessions we have been talking on financial accounting. We have covered 14 lectures under the series Financial Accounting. Today is the 15th lecture and today we would be talking on adjustments. In the first half we would be discussing on meaning and need of adjustment, whereas in the second half we would be discussing on important adjustments and their accounting treatment. And for this very discussion we have once again with us in our studios Professor M.C. Sharma. Professor Sharma is associated with the Department of Commerce, Shahid Bhagat Singh Evening College, University of Delhi. So dear friends, let's welcome our guest Professor Sharma and let's try to understand more and more about adjustments. Hello sir, welcome to the UGC lecture.
Thank you. Dear friends, in last few lectures we studied financial statements. Financial statements includes two important statements. One is income statement or profit and loss account, and in which we learned how to prepare trading and profit and loss account, and also for a manufacturing concern how to prepare a manufacturing account. And we also discussed how to prepare a balance sheet. So the financial statements covers these two statements, income statement and balance sheet, that is financial position statement. And in this reference, in financial statements when we prepare, the basic objective of financial statements is to calculate true and fair profits and the financial position of the firm. So to calculate true and fair profit, we need to make some adjustments. So in today's session, we shall be first discussing the meaning and need of adjustments to financial statements. So we know that the main objective of financial statements is to show true and fair profits or the results of the business and financial position of the firm. And for this purpose, we need to follow accounting principles. Some of the relevant accounting principles are accounting period. According to this principle, financial statements are prepared for a particular accounting period. Normally it is the 1 year and we follow financial year, that is starting from 1st April to 31st March of the coming year. So all the financial statements are prepared for a particular accounting period. Second principle which is relevant is matching principle. According to matching principle, the revenue of a particular period should be matched with the expenses incurred to earn this revenue. Third relevant principle is accrual. According to accrual concept, revenues and expenses are to be recorded on accrual basis, not on cash basis. That is not actually paid or received, but the expenses which belong to the particular year and have the services have been availed, we must record in the current period whether we have paid it or not. Another accounting principle which is relevant to financial statements, it is going concern. According to this principle, the value of assets and liabilities should be shown on going concern basis. So with reference to these accounting principles, we will see why the adjustments are required. So we know that when we prepare the income statement, revenues and expenses are to be recorded. As per accounting process, first we record business transactions in the books of journal, then we classify them into ledger, and then we prepare the trial balance. And as you know, the trial balance is a very important statement, and with the help of this trial balance, we prepare financial statements. So if we check the trial balance, we notice that some of the balances of revenues and expenses do not show the correct amount for the full accounting year. For example, the salaries have been paid February salary has been paid in March. So it is recorded in books, but the salary for the March shall not be recorded till it is paid. So it will be recorded in the month of April. So if we check the trial balance, the salaries will show for 11 months. So 1 month salary is not given. So if we do not make adjustment for this 1 month salary, this matching principle shall be violated. So we see that the items of revenues and expenses may not show the correct amount for the full accounting year. So that's the reason that we need to make adjustments for the amount which belong to the current year but has not been recorded in the books. So we need to take them in, otherwise our profits disclosed by the income statement will not be true and fair. So all these adjustments are necessary for correct matching of revenues and expenses incurred to earn those revenues. Then we see adjustments are also required to record assets and liabilities at their correct value. By taking into account any wrong treatment, the error of principle, which in brief we have discussed in our lecture number 11, the trial balance. According to this error, this nature of error, some revenue nature expense or income may be treated as capital nature. So that is the wrong treatment and that affects the value of assets and liabilities also. So we need to correct them if there is any wrong treatment. We also need to consider the non-cash expenses. Depreciation is the best example. Depreciation is the decrease in the value of assets due to its wear and tear, passage of time, obsolescence and other reasons. So to show the correct value of asset, we need to make adjustment for depreciation. Similarly, in case of proprietorship firm and partnership firm, owners may be allowed interest on their capital. Normally, this interest is not paid in cash to the owners or partners. The interest is calculated and credited to their account at the end of the year. So if the interest on capital, no treatment has been made, then the financial statements will not be correct. So therefore, this is also a non-cash item. Similarly, there will be non-cash income like interest on drawings. If a firm is charging interest on drawings taken by the partner or the owner, then this is again a transaction which is to be recorded at the end of the year. So the adjustments are also required to record the assets and liabilities at their correct value, following particularly this going concern and also considering the non-cash income and expenses. There is one accounting principle which we have discussed earlier, that is prudence principle. According to prudence principle, the anticipated losses such as the provision for bad debts and provision for discount on debtors are also incorporated through adjustments. Anticipated losses are those losses which may occur in future and we do not know the exact amount or there is no surety about that, but there is a chance of incurring losses. So on the basis of our past experience, we estimate the value of these anticipated losses and we need to make the adjustments. So thus we can say that the corrections in the existing balances of revenues and expenses given in trial balance are called adjustments. So these adjustments are to be made at the end of the year and to calculate the true and fair profits, and the reasons is that we need to follow the accounting principles while preparing financial statements. So our financial statements show the true and fair results and the true and fair financial position of the firm. Now we would like to explain the important adjustments. There is a long list of adjustments which we see. closing stock, outstanding expenses, prepaid or unexpired expenses, accrued income, unearned income or income received in advance. Closing stock is the goods which is unsold at the end of the year and not recorded in the books, so we need to record it. Remaining these four adjustments: outstanding expenses, prepaid expenses, accrued income, unearned income or income received in advance. With these reference to these four adjustments, we apply the accrual principle or matching principle. So expenses which belong to the current year but not recorded, or expenses which belong to the coming year but recorded in the current year. Similarly, the income which belong to the current year but not received, and the income received in the current year but belong to the coming year. So due to these two matching and accrual principles, we need to make adjustment for these four items. Then if some bad debts have been incurred but no entry has been passed, so that we need to make adjustment for bad debts. And we also make a provision for bad and doubtful debts on debtors, provision for discount on debtors. The provision for discount on creditors are also made by some firms, although there are two different opinions which we will discuss later. Then depreciation, interest on capital, interest on drawings, interest on loan. There are some adjustments which are related to goods. Goods are those items in which a firm deals. The loss of goods due to theft, accident or any other reason. Then goods withdrawn by the proprietor for personal use, goods given as charity, goods distributed as free samples, goods sold on sale or return basis, goods used in construction of a fixed assets. So all these items are related to goods. If we do not make adjustments, the trading account will not show the correct gross profit. So we need to make the adjustment for these items or transactions relating to goods. There are some other adjustments which depends upon calculation of profit. One of them is the commission payable to a manager. Commission payable to a manager sometimes may be dependent on the net profit earned by the firm. So therefore, this adjustment will be made at the end of the accounting year. And loss of fixed assets like the goods, there may be a theft or accident, fire, any other reason for loss of fixed assets. So accounting treatment is required if not already done there. Then we need to write off deferred revenue expenditure. While discussing the financial statements, we have discussed this deferred revenue expenditure. Deferred revenue expenditures are those expenditures which are of revenue nature, but their benefits are derived for more than 1 year. So when the benefits are derived for more than 1 year, they should be written off over the period of benefit. So the adjustments may relate to this deferred revenue expenditure. Then errors and omissions. In the trial balance, we have discussed in brief the errors and omissions. There may be some errors in accounting, and as soon as we know these errors, they must be rectified. Similarly, for omissions are partial omission and complete omission. So all these omissions which they comes into notice, normally at the end of the year we try to find out such errors and omissions, so we can make the adjustments for them, we can rectify them and calculate correct profit, true and fair profit. There may be some other adjustments because the business is the very dynamic activity and many types of the transactions may be there which may affect the profits of the firm. So any item which has not been recorded but must be recorded as it affects the profit of the firm, so those adjustments should be made. So we'll discuss all these adjustments and their accounting treatment. We now start from the closing stock. We know that the closing stock is the goods unsold at the end of the year. And as we have discussed the recording business transactions, we record the purchase of goods, we record the sale of goods, we record the sales return, that is the goods returned by our customers, and we also record the purchase return, that is goods returned to the suppliers. But nowhere we have discussed till date that how to record the closing stock. If we do not record the closing stock, then our profits calculated will be wrong, because the whole goods purchased shall be considered as expense, as we know that we record it on the debit side of trading account, and sales we record on the credit side. But if unsold goods is not recorded, then the profits calculated by the gross profit, particularly in trading account, will not be true. So we need to make adjustment for this closing stock. Another thing which is very important regarding this stock, that normally the value of a stock is given as additional information after the trial balance, and the stock is valued at cost or market price, whichever is lower. This is also called the LCM rule, lower of cost or market price. So we need to show this closing stock either at cost or market price, whichever is lower. For example, cost of unsold goods at the end of the year is rupees 12,000, having a market value of 15,000. So in this first example, the cost is 12,000, market value is 15,000. So lower of the two is cost. So the closing stock shall be recorded at the cost price, that is rupees 12,000. In the second example, cost of unsold goods at the end of the year is 12,000, having a market value of 10,000. So the firm has purchased these goods for rupees 12,000, while the market value at present is 10,000. So at what price the goods closing stock should be recorded or shown in the books? So as per LCM rule, that is also as per accounting standard on inventory, that the closing stock should be recorded at the lower of the cost or market price. So here the market price rupees 10,000 is lower. So the closing stock shall be recorded at rupees 10,000. Now we should know the adjustment entry for closing stock. Adjustment entry for closing stock is closing stock account debit or stock account debit to trading account. So when this entry is passed, so the stock is recorded having a debit balance and trading account is credited. Normally when the students are doing the question in the examination, they are not asked to pass the adjustment entry. Sometimes they are given a trial balance and some adjustments, and they are asked to prepare the financial statement directly. So we should also know the treatment of closing stock in final accounts. In final accounts, first of all we show this closing stock on the credit side of trading account, and then number 2 we show it on the asset side of the balance sheet. So this adjustment is to be shown at 2 places in the financial statements. Now the question is, why at 2 places? We know that we are following double entry system, and every transaction affects the 2 accounts. One account is debited, other is credited. So whenever we pass any adjustment or adjustment entry, it will affect the 2 places or 2 accounts. So we have to record it at the 2 places. But when you go through the questions, sometimes you find there is one new term, adjusted purchases, in the trial balance. Now the question arises, what is adjusted purchases? Adjusted purchases may be defined as the purchases after adjustments of opening stock and closing stock. So if the amount of opening stock of goods and closing stock has been adjusted in purchases, then adjusted purchases will be given in the trial balance. So whenever you find adjusted purchases in trial balance, you will also notice that the closing stock is given in the trial balance. So when closing stock is given in the trial balance, it means that the purchases has been adjusted and opening stock and closing stock has been adjusted in purchases. So the treatment will be the different, because now it is not an adjustment, it is given in trial balance. Adjustments are those items which are given as additional information to the trial balance. So in this case, the closing stock having a debit balance will be shown on the asset side of the balance sheet. So you need to take precaution while treating the closing stock, that when closing stock is given in adjustment, it should be shown on the credit side of trading account and asset side of balance sheet under the heading current assets. When closing stock is given in trial balance, then it should be shown only in the balance sheet. Now we discuss next adjustment. This is outstanding expenses or unpaid expenses. Outstanding expenses or unpaid expenses may be defined as the expenses due but not paid. When expenses become due? Expenses becomes due when the services has been availed. For example, the employee has done the job for a particular month. It means the firm has availed his services, so the salary for the month has become due. Similarly, workers has done the job, so wages has become the due. Similarly, there may be, if we have a building or office or showroom on rent basis, we have used for the current month, so automatically the rent has become due, whether paid or not. So if not paid, then this is outstanding expenses. So in real life, there may be many examples: outstanding wages, outstanding salaries, outstanding rent, there may be outstanding telephone and mobile bills, there may be outstanding electricity bill. So any expense may be outstanding for which we have availed the services but not paid the expenses. So what entry we need to pass for it? Adjustment entry. For this we need to pass expenses account debit to outstanding expenses account. For example, if wages are outstanding, then we will pass entry wages account debit to outstanding wages account. Similarly, if salaries are outstanding, then we shall pass the entry salaries account debit to outstanding salaries account. If we are not passing an adjustment entry and preparing financial statements directly, then we should know what should be its treatment. First of all, outstanding expenses are added on the debit side of trading account or profit and loss account to the respective item. For example, wages outstanding shall be added to wages on the debit side of trading account. Rent outstanding shall be added to the rent on the debit side of profit and loss account. So it will depend upon that which items are given. If it belong to the trading account, then treatment will be in trading account. If the item belong to the profit and loss account, then it will be treated in the profit and loss account. So at the first place, or one treatment is showing it on the debit side of trading or profit and loss account. Then the second aspect, that outstanding expenses, it is an obligation to pay, so it is a liability. And normally these expenses are payable within a year in the short time, so these are the current liability. So in the balance sheet, outstanding expenses are shown as a liability under the heading current liabilities, whether outstanding wages, salaries, rent or any other item. But if adjustment has already been made, before that we will see one example. The trial balance items we have shown here, the two: wages 4,600 and salaries 22,000. Wages due but not paid are 900 and salaries outstanding 2,000. So in the profit and loss account, on the debit side trading account, this wages 4600 plus we will show add 900 outstanding wages and total will be 5500. Similarly, for salaries, profit and loss account debit side salaries 22,000 and then we shall add outstanding salaries 2,000 and the total amount will be 24,000. Sometimes outstanding expenses like outstanding wages or salaries may be given in the trial balance on the credit side balance. So, if you notice outstanding salaries having a credit balance and given in the trial balance, what does it mean? It means that adjustment for outstanding salary has already been made by passing a journal entry. So, therefore, we do not require to pass any adjustment entry. For trial balance items we pass only the closing entry. That closing entry is only for nominal accounts, that is revenue and expenses. So, the outstanding expenses whether wages or salaries, then it will be shown directly in the balance sheet. So, if you notice that any item given relating to outstanding expense in the trial balance, you should show directly in the balance sheet on the liability side. And if it is given in trial balance and some additional information is given, then we need to make a proper treatment according to double entry system. If asked to pass a adjustment entry, then we will pass an adjustment entry, and not required adjustment entry, then we will show it at the two places, one on the debit side of trading account or profit and loss account, and the other in the balance sheet as a current liability. So, all adjustments are to be recorded at the two places. So, we saw the closing stock, it is recorded at two places, trading account credit side and the balance sheet the asset side. Similarly, outstanding expenses, debit side of trading account or profit and loss account and the asset side of the liability side of the balance sheet. So, these are the two adjustments, and we shall continue to discuss some more adjustments. Welcome friends in this new second session of today's lecture, and we are continuing some more adjustments. The next adjustments we shall discuss, that is prepaid expenses. Prepaid expenses are also called unexpired expenses. Prepaid expenses may be defined as the expenses paid in advance. That is, they belong to the current accounting period but has been paid in the current period. And there are many examples of prepaid expenses. Particularly, insurance premium is the very common example, because the insurance premium is payable to the insurance companies in advance. In case of general insurance like fire insurance or any other marine insurance or any other insurance, the insurance premium is paid in advance for the 1 year. So, if a firm has paid the insurance premium on the 1st July 2014, so it means the period will continue in the coming year for 1 year, that is 30th June 2015. So, if we are preparing the financial statements on 31st March, so we will notice that the benefit of the 3 months, that is 1st April to 30th June 2015, that is not derived in the current financial year. So, the expense or the insurance premium for these 3 months belong to the coming year. So, the insurance premium for these 3 months is called prepaid insurance premium. And in personal life also, particularly in any metro city, in any city, you are asked to pay the rent in advance. So, in case of business also it is possible, when the firm has hired a building, it has to pay the rent in advance. So, if the rent has been paid in advance, it does not belong to the current year, then we need to make adjustment for that. We call it unexpired expenses, because the expenses which has been paid for a particular period has not expired in the current year. So, it is also called the unexpired expenses. So, in real life many examples may be there, but the adjustments which given in the trial balance, we need to make adjustment for that. This is that if how to pass the journal entry. Journal entry or adjustment entry will be for this prepaid expense account debit to expense account. For example, for insurance premium, we shall pass the entry prepaid insurance premium account debit to insurance premium account. Because the insurance premium which we have debited previously, that is an expense but does not belong to the current year, so it is a decrease in expense has been credited. Prepaid expense is an asset because the amount is receivable in either in cash or kind. So, assets are to be debited. So, this entry is prepaid insurance premium account debit to insurance premium. So, similarly, if the prepaid rent is there, then we shall pass the entry prepaid rent account debit to rent account. If we are making adjustment directly in the financial statements, then we shall deduct the prepaid expenses on the debit side of trading account or profit and loss account. If wages are prepaid, then we shall deduct the prepaid wages from the wages on the debit side of trading account. If the prepaid rent is, then we shall deduct the prepaid rent amount from the rent account on the debit side of P&L account. And second time it will appear in the balance sheet, asset side of balance sheet. Asset side because the amount is recoverable either in cash in kind, so it is an asset. Sometimes the prepaid expenses may already treated and may be given in trial balance. So, when the prepaid expense like prepaid rent, prepaid insurance premium is given in the trial balance, in that case we shall show it directly in the balance sheet. Prepaid expense will be shown as an current asset in the balance sheet on asset side. Another thing that there may be a hidden adjustment. Hidden adjustment, in this case the example which I have given you, that insurance premium is paid by the firm on 1st July 2014 is rupees 1000 for 1 year. The firm closes its accounts on 31st March every year. So, on 31st March we need to calculate at our own, although adjustment may not be given clearly in the question. Even then, because the date is mentioned that paid on 1st July for 1 year, so we know that the 3 months will come into the next accounting period. So, we need to calculate the prepaid insurance. In this case, prepaid insurance will be annual premium, that is 1000 into 3 by 12 for 3 months, that is rupees 250. So, sometimes in case of some item, particularly this insurance premium, there may be a hidden adjustment, and in case of hidden adjustment you need to notice it at your own. So whenever the date is given, whenever any other information is given, so we need to interpret it properly. For example, the rent page is given and they are given the rent paid for 13 months, and we know that the 1 year has the 12 months. It means that the 1 month rent has been paid in advance in absence of any other information. So we can calculate the rent of 1 month, that is the total rent paid divided by 13. So we will find out the figure, the 1 month rent, and we have to make an adjustment. So sometimes there may be the hidden adjustments whenever any additional information like date of payment in case of insurance premium, or the number of months given in case of the salaries, or in case of the rent paid. So we have to notice it and make the treatment at our own. Then next adjustments is accrued income. Similar to expenses, outstanding expenses, there may be outstanding income, that is income due but not received. So this income due but not received is called accrued income. Accrued income is the income which has become due in the current year and but has not been received. So according to matching concept, income belong to the current year, so we need to make an adjustment for this. The few examples are here: rent due but not received, interest due but not received, commission due but not received, maybe any other income. Now what adjustment entry should be passed for it? Entry will be accrued income account debit to income account. Income is to be credited, so we shall calculate this amount, or it is already given, then we shall pass. If the accrued income is accrued rent, then entry will be accrued rent account debit to rent received account or rent account. If there is accrued interest, then entry will be accrued interest account debit to interest account. If we are treating it directly in final accounts, then it will come on the credit side of profit and loss account, because all other incomes other than sales are to be shown on the credit side of P&L account. So we add this accrued income to the profit and loss account on the credit side in the respective item, and the second time we show it on the asset side of the balance sheet as a separate item under the current assets, because it will be receivable within a year, so it is the current asset. If any accrued income is already given in the trial balance, it means that the adjustment has already been made and we have to show it directly on the asset side of balance sheet. Sometimes there may be implied adjustment for this accrued income also. I have given here one example. There is 12% government bonds, face value 10,000, have been purchased by a firm on 1st October 2015 for rupees 9,500. So 12% government bonds means the rate of interest on bonds is 12%. So interest on the bonds is payable annually on 30th September every year. So in the current year, the no interest is received, but from 1st October 2015 to 31st March 2016, the interest has accrued on these government bonds at the rate of 12% per annum. So we shall calculate at the rate of 12% on 10,000, because interest is always calculated on the face value. So 1200 is for the full year, but we need to consider only from 1st October to 31st March. That is October, November, December, January, February, March, 6 months. So that 600 will be the accrued interest on the government bonds, and then we need to pass the adjustment entry for accrued income. So whenever any asset is given and rate of interest is given, we need to take care of that. Next adjustment is unearned income or income received in advance. Income received in advance but not due. We have, suppose, our building, and we have taken the rent, advance rent for 3 months, on the 1st March. So, the 1 month rent will become due in the current year, but the remaining the 2 months will be the rent received in advance. So, there may be rent received in advance, commission received in advance, interest received in advance, or any other income if we have received it, but we have not paid the services against that. So, therefore, this is the unearned income. So, this income does not belong to the current year. So, according to matching concept, we need to make the adjustments for it. The adjustment entry for this unearned income will be income account debit to unearned income account. Because income we have already credited, but it does not belong to the current year. So, there will be decrease in income. So, income account debit to unearned income account. And in as far as accounting treatment is concerned, we will show in financial statements unearned income we shall deduct from the respective income on the credit side of profit and loss account. And in the balance sheet we shall show it as a liability, because it is our obligation to pay it either in cash or kind. Suppose our tenant leaves on the 1st April, we have to refund the 2 months rent, so it is a liability. So, unearned income we need to treat it, if we are treating directly, that is deduct from the respective income on the credit side of profit and loss account and show it as a liability in the balance sheet. So, we discussed closing stock, outstanding expenses, prepaid expenses, and accrued income and income received in advance. Now, we will discuss the depreciation. Depreciation is very important adjustment, because all the firms have fixed assets like land, building, plant, furniture, motor vehicle and others. Except land, these assets are depreciable. They have a fixed economic life, and after that economic life they become useless. So, we need to write off the proportionate amount of benefit out of that asset. And the depreciation being lost, we pass the adjustment entry depreciation account debit to asset account. Narration we shall record, and the depreciation charged on asset may be the machinery, then we shall pass entry depreciation account debit to machinery account. If depreciation has been charged on furniture, then depreciation account debit to furniture account. So, similarly we will make the change in this entry. If we are directly showing in the financial statements, then depreciation being indirect expense, we show it on the debit side of profit and loss account. And when there is a manufacturing company and we are preparing manufacturing account, then the depreciation on factory building, plant and machinery will be shown in the manufacturing account, and depreciation on furniture and other items, motor vehicle, will be shown in the profit and loss account. While preparing balance sheet, this depreciation charged during the current year is deducted from the respective asset in the balance sheet. Like depreciation on machinery shall be deducted from the machinery in balance sheet. Depreciation in furniture, it will be deducted from the furniture in the balance sheet. So, the depreciation charge on different asset will be shown by deducting from the respective assets on the asset side of balance sheet. Sometimes the accountants have already made adjustment for depreciation, already charged depreciation, then depreciation will be given in the trial balance. So, when depreciation is given in the trial balance, no adjustment is required. Depreciation will be shown on the debit side of profit and loss account, income statement, that is. So, this is the treatment of depreciation. Now, bad debts. Bad debts is the amount which has become irrecoverable. We know that the credit sale is the common feature of a nowadays new business. So, when we have sold goods to a customer on credit basis and due to some reason the customer has not paid it, and when we checked from the customer, account and we estimated that the amount has become irrecoverable. Irrecoverable means bad, it cannot be recovered. So the bad debts is a loss. So we need to pass an entry for this, that is bad debts account debit to debtors account. Debtors account individually, that individual debtors account shall be credited. So this entry is passed when we are sure, we are confirmed that the amount has become irrecoverable. How to treat it in the final accounts? In final accounts, bad debts being loss is to be shown on the debit side of profit and loss account. And the value of the debtors has decreased, so we deduct it from debtors on the asset side of balance sheet. Normally, when we notice that bad debts has become, we pass the entry. So you may notice that the bad debts may also appear in the trial balance. When the bad debts is already given in the trial balance, then it is not adjustment, and we shall show it directly on the debit side of profit and loss account. Relating to bad debts, there is one more adjustment, provision for bad and doubtful debts. There is one accounting principle, prudence principle, and according to this principle, we need to account for anticipated losses. So on the basis of past experience, suppose we have noticed that the 5% on an average basis of average debtors becomes bad. It means that whatever amount of debtors is outstanding at the end of the year, the 5% of that may become bad. So anticipated losses, they are to be recorded, and due to this prudence principle or conservative principles, we pass entry or we make adjustments for provision for bad and doubtful debts on debtors. So when provision for bad and doubtful debts is made, so we know that the provisions are made for the expected losses where we are not sure about the amount of expense. So we cannot identify which debtor will become the bad. So we estimate it on the basis of our past experience. Now the accounting treatment for provision for bad and doubtful debts, as it is a loss, so we charge it on the debit side of profit and loss account. So we make the entry profit and loss account debit to provision for bad debts or provision for bad and doubtful debts. How to treat in final accounts? First, being a loss, it is to be shown on the debit side of profit and loss account. And the value of debtors, we need to show the assets and liabilities at their correct value. So this much amount which when we are expecting to become the bad, we shall deduct the provision for bad debts amount from the debtors on the asset side of balance sheet. There sometimes you may notice that the provision for bad debts is already given in the trial balance. We call in the common language, in accounting common language, we call it the old provision. Old provision means the provision which we have already made existing in our books. So in this case, when the bad debts is already given, bad debts provision is given, we need to make how to show or how to treat it in final accounts. So in profit and loss account, we need to show the bad debts. One is the bad debts which are given in trial balance. Then we add the further bad debts. Further bad debts are those bad debts which are given in the adjustments. And the new provision that is given in the adjustments. Because all these three are losses, bad debts which already incurred, further bad debts which we have noticed again and passed the entry for that, and we have made a provision. After making the total of these three items, bad debts plus further bad debts plus new provision, we deduct the old provision. Old provision, the provision which has already been made. So we know that the provision which we have already know, that much amount was automatically charged in the previous year. So we do not need to charge it again. So we deduct the old provision for this total. Sometimes the amount of old provision given may be more than the sum of bad debts given in trial balance, bad debts given in adjustments, and the new provision. In that case, these items will be shown on the credit side of profit and loss account. There we shall show, as you are seeing on the screen, that old provision for bad debts, the first of all, then we shall deduct these three items: bad debts given in trial balance, further bad debts given in the adjustments, and the new provision to be made for bad and doubtful debts given in the adjustments. And the remaining amount will be shown in the amount column. So we need to check. In normal course, it is the bad debts, then plus further bad debts, plus new provision minus old provision. And if the old provision total is more than these three items, in that case it is the on the credit side old provision and deduct bad debts, further bad debts, and new provision. So what we have noticed that if we are making the direct adjustments, so how much amount should be charged to profit and loss account? This can be calculated on the basis of this equation. Just see on the screen that bad debts plus further bad debts plus new provision minus old provision. Bad debts means the bad debts given in trial balance, further bad debts given in adjustments, new provision which is to be made given in adjustments, and old provision which has already been made and appearing in the trial balance. Now the one more adjustment we shall discuss today, that is provision for discount on debtors. This adjustment is again based on the prudence principle, because we know that the discount or cash discount is allowed to debtors for the prompt payment. Prompt payment means if the sum of the debtors pay before the due date, they may be allowed the cash discount by the firm. So on the basis of our past experience, we may estimate or determine that how much of debtors pay and how much cash discount we need to pay. So we shall calculate this figure as per instruction, and then what entry should be passed? Entry will be profit and loss account debit to provision for discount on debtors, similar to like the provision for bad debts. In final accounts, we shall show it on the debit side of profit and loss account, and we shall deduct the amount on asset side of balance sheet. Now some points are to be noticed, very important. What the important points are there? The new provision for bad debts is calculated on debtors left after deducting further bad debts and making any other adjustments affecting debtors. So if any adjustment, any transaction is affecting the debtors, then we should find out first the net amount of debtors, then we should deduct from it the further bad debts, and the balance amount left on that we should calculate the new provision. Similarly, the amount of new provision for discount is calculated on the debtors after deducting the further bad debts and new provision for bad debts. So now we see that when we are calculating the discount which is to be charged to the debit side of profit and loss account, we could use the similar equation, that discount allowed plus provision to be maintained, that is the new provision for discount minus old provision, that is provision given in the trial balance. We could understand this with the help of one small example. In this example, the trial balance items are given on 31st March 2015. debtors 32,000, bad debts 1,000, provision for bad debts 800 on credit side. Three adjustments are given. Write off further bad debts rupees 2,000, make a provision for bad debts on debtors at 5%, make a provision for discount on debtors at 2%. So, how much is the new provision? New provision for bad debts will be rupees 1,500, that is 5% of 30,000. From where we got 30,000, that is debtors 32,000 minus further bad debts 2,000. So, the provision for bad debts shall be calculated on the net debtors. Then provision for discount, it is calculated after on the debtors after deducting further bad debts and provision for bad debts. So, further bad debts 2,000, new provision for bad debts 1,500, so remaining amount is 28,500. So, we have calculated 2% of this amount, that is 570. So, when we see in this profit and loss account how to show it, that is bad debts 1,000 given in trial balance, further bad debts 2,000 given in adjustments, new provision 1,500, total is 4,500, and after deducting the old provision for bad debts 800, the net amount is shown in the amount column 3,700, and provision for discount, that is 570. So, today we have discussed the adjustments, their meaning and importance, and some of the important adjustments which are commonly asked, frequently asked in the questions. And in our next lecture we will continue those adjustments which have not been discussed in the current lecture.
With this note, thank you sir, thank you so very much. And dear friends, of course, so we would be meeting again tomorrow and would be talking more on adjustments. Till then, take care, goodbye, and yes, keep watching us and keep giving your feedback at info.cc@nic.in. Thank you sir, thank you so very much.
Okay, thank you.